The latest RV and economics updates from the Seeds of Wisdom, Saturday evening, June 29, 24. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Europe's MiCA will take effect on Sunday, ushering in a new age of transparent crypto regulation. MiCA provides regulatory clarity to the entire digital assets market across the Eurozone, making Europe one of the first Western countries to implement a clear framework that crypto exchanges, digital assets companies, and stablecoin issuers can adopt to remain compliant. The framework aims to protect European investors from the fraud and risks plaguing the crypto markets while fostering innovation, economic competitiveness, and the interest of the Eurozone. MiCA pushes for innovation in its stipulations around stablecoins, which will allow euro-denominated stablecoins to replace the dollar-denominated variant. Under the new rules, stablecoins will be treated as electronic money, subjecting issuers to the same levels of compliance as traditional banks and money transmitters, including a one-to-one redemption to the euro. While the framework pushes for bold reforms, it also emphasizes protecting the European investor by mandating digital service providers obtain licenses as either digital asset service providers, DASP, virtual asset service providers, VASP, or crypto asset service providers, CASP. Global stablecoins are not allowed under MiCA, and stablecoins pegged to other cryptocurrencies must primarily comply with European e-money licensing requirements. This would entail abiding by prudential, financial crime compliance, and other rules. To boost job and economic growth, licensed entities must maintain a local presence within the EU, which will serve as a base for their European operations. While MiCA is a step forward, it is not without fault. Some of its faults include the cost of compliance, which could be burdensome on smaller crypto exchanges and service providers. Vague, virtually non-existent, stipulations around decentralized finance, and a lack of flexibility in some stipulations, like those around stablecoins. Less than 1 in 10 firms are fully prepared for MiCA, with 25% having made no preparations. The first stage of the European Union's markets in crypto assets regulation, MiCA, will come into play on the 30th of June. However, a new report by AcuiD, the management intelligence platform, and conducted by Aventis, the trade surveillance software provider, has found that a move to establish market surveillance systems is underway as firms find themselves underprepared. MiCA represents one of the first comprehensive regulatory frameworks for crypto trading to be developed in a major financial jurisdiction, and its adoption will increase requirements for market participants in a range of areas. The study, The Impact of MiCA on Crypto Market Surveillance, Insights and Challenges, was based on a survey and series of interviews with senior executives at 68 firms engaged in crypto trade across the buy side, sell side, and exchanges. It found that, of the firms that were in scope for MiCA, just 9% were fully prepared, and a quarter of firms had not begun preparations. With MiCA coming into full effect at the end of the year, it is important that firms identify whether they are in scope now and begin preparations to comply. In terms of market surveillance, the MiCA regulation is based upon requirements set out in the EU's Market Abuse Regulation, MAR. For many firms, particularly crypto-native firms coming into scope for the first time, there will be a significant operational lift to put in place the systems required to be compliant. This study found that there were still high levels of firms that were not sure if they were in scope. For firms that are not already operating under MiFID II, MiCA will present a significant operational lift to become compliant. And it is no surprise that we found that firms were looking to third-party vendors to assist them in their preparations, says Ross Lancaster, head of research at AcuiD. There is a relative lack of awareness among some areas in the market as to who is in scope, which will need to be addressed if firms are going to have time to get ready for compliance. IBKR's Forecast X secures CFTC approval to launch prediction market. The Commodity Futures Trading Commission, CFTC, has approved Forecast X LLC's application to operate a contract market and derivative clearing organization. Forecast X, a wholly owned subsidiary of Interactive Brokers, starts operations on Monday, July 8, 2024. Interactive Brokers clients from eligible countries will have immediate access, the brokerage firm announced, as it is the first Futures Commission merchant to join as an exchange member. Markets are the most direct ways of expressing our unbiased expectations. After its initial launch, Forecast X will expand internationally and cover additional local and controversial global issues, the firm stated. UK is 3 months away from transition away from US dollar Libor. The Financial Conduct Authority has reminded market participants of the expected cessation of the remaining synthetic US dollar Libor settings at the end of September 2024. We have no intention to use our powers to compel EBA to continue to publish the settings beyond this date, the regulator stated. Market participants with outstanding US dollar Libor exposures must make sure they are prepared for these remaining synthetic US dollar Libor settings to cease by the expected deadline. The FCA further warned that parties to contracts still referencing US dollar Libor should be taking steps to transition to appropriate, robust reference rates, renegotiating with counterparties where necessary. The FCA and BOE have been taking steps to promote the switch from Libor to SONIA. Throughout the last few years, they actively provided guidance to lenders, borrowers, and investors who are amending their documentation to reference SONIA. Nevertheless, the transition from US dollar Libor remains of critical importance globally, including in the UK where many firms are active in US dollar interest rate markets. Libor, which underpins more than $300 trillion in derivatives and other instruments, is set to be replaced worldwide with the Bank of England's SONIA rate for sterling-denominated swaps, loans, and futures. Instead of interbank offered rates, the FCA notes that overnight SONIA is now fully embedded across FX markets. Successful CCP conversion processes saw some of the largest single-day amendments to financial contracts, with in excess of £13 trillion Libor referencing contracts converted to SONIA. This shift is expected to boost liquidity in these products, which aided relevant providers in achieving the working group's key milestone of ceasing Libor-linked derivatives. Analysis: How the Fed's rate policy spurred crypto adoption in Africa. Increases in U.S. interest rates are historically considered to generate adverse spillovers to emerging market economies, EMEs, including those in Africa. However, whether these rate hikes are detrimental depends on their underlying causes. Higher rates resulting from stronger U.S. growth generate only modest spillovers to African financial markets. In contrast, rate hikes stemming from hawkish Federal Reserve policy or inflationary pressures are much more disruptive, often leading to capital outflows and currency depreciation. African currencies have struggled against the US dollar over the last 2 years, and they are unlikely to see recoveries soon as long as the Federal Reserve continues to delay cutting interest rates. This sustained pressure has driven many Africans to seek refuge in cryptocurrencies, which are perceived as less susceptible to the Fed's monetary policy changes. According to Chainalysis, Africa received $117.1 billion in on-chain crypto transactions between July 2022 and June 2023. Although it has consistently been one of the smallest cryptocurrency markets, a closer analysis reveals that crypto has penetrated key markets and become an important part of many residents' day-to-day lives. The Fed's higher interest rates have indirectly contributed to this trend by exacerbating economic conditions in these countries, prompting people to seek financial alternatives. That said, experts on the ground also observed that crypto fans in Africa have shifted their focus from Bitcoin to stablecoins due to their lower price volatility compared to the original cryptocurrency. Trade finance to play major role in $30 trillion tokenized assets market. Demand for tokenized real-world assets could reach $30.1 trillion by 2034, with trade finance assets making up a significant part of the market, predicts a paper from Standard Chartered and Synpulse. Currently, the tokenized asset sector is mainly made up of traditional assets like U.S. Treasuries and money market funds. However, the supply side is still in its infancy, with the total value of tokenized assets, excluding stablecoins, standing at just $5 billion in early 2024. However, the paper argues that growing industry digitization and the specific features of real-world trade finance assets make it an ideal category to originate tokens. Currently, trade finance assets are underinvested due to lack of familiarity, pricing inconsistency, and operational intensity. Tokenization has the potential to address these challenges, whilst also reducing information asymmetry and offering transparency to investors. By 2034, trade finance assets could become one of the top 3 tokenized assets globally, at 16% of the $30.1 trillion total, predict the authors. Kai Fair, global head, trade, Standard Chartered, says, "We see the next 3 years as a critical junction for tokenization, with trade finance assets coming to the fore as a new asset class. To unlock this trillion-dollar opportunity, industry-wide collaboration among all stakeholders, from investors and financial institutions to governments and regulators, is critical. Banks need to increasingly take on the role of bridging the existing traditional financial markets with a newer and more open token-enabled market infrastructure." China-Serbia FTA to take effect on July 1 further facilitates bilateral exchanges. The Free Trade Agreement, FTA, between China and Serbia will officially take effect on July 1, 2024, as the two sides will gradually eliminate tariffs on 90% of products in the tariff lines. Tariffs for more than 60% of products will be suspended immediately on the same day, China's Ministry of Commerce, MOFCOM, said on Friday in a statement. The FTA was signed on October 17, 2023, and both countries have completed the respective approval procedures. The final proportion of zero tariff imports on both sides will reach about 95%, covering major trade commodities. The import tariffs on the Serbian side will be gradually reduced to zero from the current 5 to 20% for Chinese products such as automobiles, photovoltaic modules, lithium batteries, telecommunication equipment, machinery and equipment, refractory materials, and some agricultural and aquatic products, according to a separate MOFOCM statement on Friday, citing an official. China will also reduce the 5 to 20% tariffs to zero for major Serbian imports, including generators, electric motors, tires, beef, wine, nuts, and other products. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Source: Dinar Recaps.